Question 1. The investigation demonstrates that a commercial liability insurance policyholder has requested a reduction in their policy's aggregate limit of liability for the current policy period, citing a decrease in their business operations. The insurer is considering this request. Which of the following represents the most appropriate approach for the insurer to take? Option A. Inform the policyholder that liability limits cannot be altered once a policy period has commenced and deny the request outright. Option B. Review the specific terms and conditions of the existing liability insurance policy to determine if and how such a reduction can be applied, considering the policy period and any relevant endorsements. Option C. Advise the policyholder to consult with their legal counsel to explore options for modifying their business operations to align with the current policy limits. Option D. Immediately agree to the policyholder's request to reduce the aggregate limit of liability, as this aligns with the principle of insuring only the actual risk. The correct answer is B. Review the specific terms and conditions of the existing liability insurance policy to determine if and how such a reduction can be applied, considering the policy period and any relevant endorsements. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire to limit their liability and the insurer's obligation to provide fair and adequate coverage under the policy. The insurer must navigate the complexities of the policy wording, the insured's actions, and the potential for third-party claims, all while adhering to regulatory requirements designed to protect policyholders and ensure market integrity. Careful judgment is required to interpret the policy's scope and exclusions accurately, and to respond appropriately to the insured's request, without compromising regulatory compliance or ethical obligations. The correct approach involves a thorough review of the specific wording of the liability insurance policy, particularly clauses related to coverage limits, exclusions, and the insured's duty to cooperate. This approach is correct because it directly addresses the contractual obligations between the insurer and the insured. Under typical insurance law and regulation frameworks, insurers are bound by the terms of the policy they issue. Therefore, assessing the insured's request against these terms is the primary and most legally sound method of determining the appropriate response. Furthermore, regulatory guidelines often mandate that insurers act in good faith and deal fairly with their policyholders, which includes providing coverage as agreed upon in the policy, subject to its terms and conditions. This approach ensures that the insurer's actions are grounded in the policy contract and are compliant with the overarching duty of good faith and fair dealing. An incorrect approach would be to immediately agree to the insured's request to reduce coverage retroactively without a thorough policy review. This is incorrect because it disregards the contractual nature of the insurance policy and potentially violates regulatory principles that prohibit insurers from unilaterally altering coverage terms after a policy has been in effect, especially if such alteration would prejudice the insured or third parties. Another incorrect approach would be to refuse the request outright without any investigation into the policy terms or the circumstances prompting the request. This fails to uphold the duty of good faith and fair dealing, as it does not engage with the insured's concerns or explore potential solutions within the policy's framework. A further incorrect approach would be to advise the insured to seek legal counsel to amend their business practices without first assessing the insurer's own contractual obligations. While seeking legal advice is generally sound, the insurer's primary responsibility is to interpret and apply its own policy terms. A professional decision-making process for similar situation should involve a systematic approach. First, understand the insured's request and the underlying reasons. Second, conduct a comprehensive review of the relevant insurance policy, paying close attention to the policy period, coverage grants, exclusions, conditions, and any endorsements. Third, consult internal underwriting guidelines and legal counsel if the policy interpretation is complex or ambiguous. Fourth, communicate clearly and transparently with the insured regarding the policy's terms and the insurer's assessment of their request. Finally, ensure that any decision made is consistent with regulatory requirements, contractual obligations, and ethical standards of fair dealing. Question 2. During the evaluation of a life insurance policy claim, it is discovered that the policyholder failed to disclose a pre-existing medical condition that was not explicitly asked about during the application process. The policy document contains a basis of the contract clause, stating that the proposal and declaration shall be the basis of the contract. The policyholder's beneficiaries argue that the non-disclosure was unintentional and that the policyholder was unaware of the materiality of the condition, which approach best aligns with the regulatory framework governing policy provisions and the duty of disclosure. Option A. Proceed with the claim settlement as the non-disclosure was unintentional and the policyholder was unaware of its materiality. Option B. Void the policy due to the non-disclosure of material fact, as the basis of the contract clause makes the proposal the foundation of the agreement, irrespective of intent. Option C. Investigate further to determine if the policyholder had a reasonable belief that the undisclosed condition was not material. Option D. Negotiate a partial settlement with the beneficiaries, acknowledging the non-disclosure but considering the policyholder's lack of intent. Correct answer is B. Void the policy due to the non-disclosure of a material fact, as the basis of the contract clause makes the proposal the foundation of the agreement, irrespective of intent. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of policy provisions and their interaction with regulatory requirements, specifically concerning the duty of disclosure. Professionals must balance the insurer's need to underwrite risk effectively with the policyholder's obligation to provide truthful and complete information. Misinterpreting or misapplying these provisions can lead to disputes, regulatory sanctions, and reputational damage. Careful judgment is required to ensure that policy terms are applied fairly and in accordance with the law. The correct approach involves a thorough review of the policy wording, specifically the basis of the contract clause and the utmost good faith provisions, and cross-referencing these with the relevant sections of the Insurance Act specify relevant jurisdictions Insurance Act, e.g., the Insurance Act 2015 in the UK, or relevant state statutes in the US. This approach correctly identifies that the policyholder's failure to disclose a material fact, even if unintentional, can render the policy voidable if the policy is written on a basis of the contract clause. This aligns with the principle of utmost good faith, which requires both parties to act honestly and with full disclosure. The regulatory framework mandates that insurers clearly communicate the implications of non-disclosure to policyholders, and the policy wording itself is the primary vehicle for this communication. An incorrect approach that focuses solely on the absence of intent to deceive fails to acknowledge the strict liability often associated with basis of the contract clauses. Many jurisdictions, under such clauses, do not require proof of fraudulent intent for an insurer to avoid a policy due to non-disclosure of a material fact. This approach overlooks the fundamental principle that the insurer's decision to offer cover and at what premium is based on the information provided. Another incorrect approach that prioritizes the policyholder's lack of awareness of the materiality of the undisclosed information also falls short. While the policyholder's understanding is a factor in some disclosure regimes, the presence of a basis of the contract clause shifts the focus to the objective materiality of the fact itself and its impact on the insurer's underwriting decision. The regulatory framework often places the onus on the policyholder to disclose all material facts, regardless of their personal assessment of materiality. A further incorrect approach that suggests the insurer should proceed with the claim without further investigation, because the policyholder was unaware of the non-disclosure, ignores the insurer's right to underwrite risk accurately. This approach disregards the contractual agreement and the regulatory expectation that insurers will investigate claims and ensure they are valid based on the terms of the policy and the information provided at inception. Professionals should adopt a decision-making framework that begins with a precise understanding of the policy terms, particularly those relating to disclosure and the basis of the contract. This should be followed by a careful review of the relevant legislation and regulatory guidance. Any ambiguity should be resolved in favor of the policyholder where the law or policy wording permits, but without compromising the insurer's fundamental right to accurate risk assessment. If a potential breach of disclosure is identified, a structured investigation should be conducted, considering all relevant facts and legal principles before making a determination. Question 3. Quality control measures reveal that a claims handler, upon receiving a complex property damage claim following a severe storm, immediately proposed a settlement significantly lower than the estimated repair costs provided by the policyholder, citing a general clause in the policy that might limit coverage. The handler did not request further documentation or engage in a detailed assessment of the damage against the policy's specific endorsements. Which approach best reflects the required regulatory and ethical standards for loss settlement in this jurisdiction? Option A. Delay the settlement process by requesting numerous minor and potentially irrelevant documents from the policyholder to allow for more time to review the claim. Option B. Approve the claim for the full amount requested by the policyholder without any independent verification, assuming the policyholder's assessment is accurate. Option C. Conduct a thorough investigation to ascertain the full extent of the damage, verify the policy coverage against the specific circumstances of the loss, and communicate the findings and settlement offer clearly to the policyholder. Option D. Immediately offer a settlement based on a broad interpretation of a general policy clause, without further investigation, to expedite the closure of the claim. The correct answer is C. Conduct a thorough investigation to ascertain the full extent of the damage, verify the policy coverage against the specific circumstances of the loss, and communicate the findings and settlement offer clearly to the policyholder. Explanation: this scenario is professionally challenging because it requires balancing the insurer's obligation to settle claims fairly and promptly with the need to investigate potential fraud or misrepresentation. The claims handler must exercise sound judgment, adhering strictly to regulatory requirements and ethical principles, to avoid both underpayment and overpayment, and to maintain the integrity of the insurance process. The correct approach involves a thorough and objective investigation of the claim, gathering all necessary documentation, and applying the policy terms and conditions accurately to determine the extent of the loss. This approach is right because it aligns with the fundamental principles of insurance law and regulation, which mandate fair claims handling and adherence to contractual obligations. Specifically, it upholds the duty of good faith and fair dealing owed by the insurer to the policyholder, ensuring that claims are settled based on the merits of the evidence and the policy provisions, without undue delay or arbitrary denial. This also prevents potential breaches of regulatory codes of conduct that govern claims settlement practices, such as those requiring prompt investigation and communication. An incorrect approach that involves immediately offering a significantly reduced settlement amount without a comprehensive investigation fails to meet the insurer's obligations. This action could be construed as bad faith, as it suggests an intent to exploit the policyholder's potential lack of knowledge or resources, and it violates the principle of fair claims settlement by not properly assessing the actual loss. Another incorrect approach, which is to approve the claim at the full amount requested without verifying the details or investigating any suspicious elements, is also professionally unacceptable. This approach risks overpayment, potentially leading to financial losses for the insurer and contributing to increased premiums for all policyholders. It also fails to uphold the insurer's responsibility to investigate claims thoroughly, which is a cornerstone of sound insurance practice and regulatory compliance. Finally, an approach that involves delaying the settlement indefinitely while continuing to request minor, relevant pieces of information is a failure to act with reasonable promptness. This can lead to significant hardship for the policyholder and may violate regulations that require claims to be settled within a specified time frame after all necessary information has been provided. Professionals should adopt a decision-making framework that prioritizes a systematic and evidence-based approach to claims handling. This involves 1. Understanding the policy terms and conditions thoroughly. 2. Conducting a prompt and comprehensive investigation, gathering all relevant evidence. 3. Objectively assessing the gathered information against the policy provisions. 4. Communicating clearly and transparently with the policyholder throughout the process. And 5. Making a fair and timely settlement decision based on the investigation and policy terms, in full compliance with all applicable laws and regulations. Question 4. System analysis indicates that an insurance company is preparing to launch a new travel insurance product in the United Kingdom. The product development team has drafted the policy wording and is seeking approval for its use. The team has noted that a competitor offers a similar product and suggests using their policy wording as a template with minor modifications to expedite the launch. They also propose that the marketing brochures will highlight the key benefits, assuming customers will refer to these for understanding rather than the full policy document. The compliance officer is concerned about the potential regulatory implications of these proposed approaches. Which of the following represents the most appropriate and compliant approach to form regulation for this new product? Option A. Conduct a comprehensive review of the proposed policy wording against all applicable UK legislation, FCA regulations, including ICOBs, and relevant consumer protection laws to ensure it is fair, clear, and compliant before issuing it. Option B. Adopt the competitor's policy wording with minor modifications, as this is likely to be compliant and commercially competitive, and focus on ensuring the marketing materials clearly articulate the product's advantages. Option C. Prioritize speed to market by issuing the policy wording with minimal review, relying on the marketing materials to convey essential information and assuming customers will seek clarification if needed. Option D. Focus on ensuring the policy wording is legally sound from a contractual perspective, assuming that regulatory compliance will be adequately addressed by the product's pricing and the insurer's overall market reputation. The correct answer is A. Conduct a comprehensive review of the proposed policy wording against all applicable UK legislation, FCA regulations, including ICOBs, and relevant consumer protection laws to ensure it is fair, clear, and compliant before issuing it. Explanation. This scenario is professionally challenging because it requires a deep understanding of the specific regulatory requirements for insurance policy forms within the designated jurisdiction, which for this exam is assumed to be the United Kingdom, governed by the Financial Conduct Authority, FCA, and relevant legislation like the Financial Services and Markets Act 2000 FSMA. The challenge lies in balancing the need for clear, compliant policy wording with the commercial imperative to offer competitive and attractive products. Misinterpreting or overlooking form regulation can lead to significant regulatory sanctions, consumer detriment, and reputational damage. The correct approach involves a thorough review of the proposed policy wording against the FCA's principles for businesses, specifically Principle 7, Communications with Clients, and Principle 6, Customers' Interests, as well as any specific guidance or rules pertaining to the type of insurance product being offered. This includes ensuring that the terms and conditions are fair, clear, and not misleading, and that all mandatory disclosures are present. Compliance with the Consumer Insurance, Disclosure and Representations, Act 2012, and the Insurance Conduct of Business Sourcebook, ICOBs, is paramount. The insurer must demonstrate that the form has been vetted by legal and compliance teams to ensure it meets all statutory and regulatory obligations, including those related to unfair contract terms. An incorrect approach of simply adopting a competitor's form without independent verification is professionally unacceptable. This fails to acknowledge that competitor forms may not be compliant with current UK regulations or may contain clauses that are detrimental to consumers. It also bypasses the insurer's own responsibility to ensure compliance. Another incorrect approach, that of relying solely on marketing materials to convey key benefits and assuming the policy wording will be understood by consumers, is also flawed. Regulatory frameworks, particularly ICOBs, mandate that the policy document itself must be clear and understandable, and marketing materials are supplementary. Failing to ensure the policy wording is comprehensible is a direct breach of consumer protection rules. Lastly, an approach that prioritizes speed to market over thorough regulatory review risks issuing non-compliant documentation. While efficiency is important, it must not compromise the fundamental requirement for regulatory adherence, as this can lead to retrospective issues and penalties. Professionals should adopt a systematic decision-making process that begins with identifying the specific regulatory requirements applicable to the product and jurisdiction. This involves consulting relevant legislation, FCA handbooks, especially ICOBs, and any industry best practices. A robust internal review process involving legal, compliance, and product development teams is essential. This process should include a gap analysis against regulatory requirements, a fairness assessment of terms, and a clarity check for consumer understanding. Any proposed form should be subject to a formal approval process before being issued to customers. Question 5. Comparative studies suggest that insurers are increasingly adopting digital technologies to streamline policy issuance. An insurance company is proposing to implement a new digital signature platform for policy applications and endorsements, aiming to reduce processing times and operational costs. The compliance department is tasked with ensuring this new process aligns with relevant NAIC model laws and regulation. Which of the following approaches best ensures compliance with the NAIC framework? Option A. Implement the digital signature platform immediately to gain a competitive advantage, with a plan to address any potential regulatory issues that may arise after the system is operational. Option B. Proceed with the implementation of the digital signature platform after a brief review by the legal department to confirm general technological feasibility, assuming that the platform's widespread use implies regulatory acceptance. Option C. Conduct a detailed review of the proposed digital signature process, cross-referencing its functionality and data security measures against the specific requirements of the NAIC Model Unfair Trade Practices Act and the NAIC Model Producer Licensing Act, and consult with legal counsel to confirm adherence to all applicable provisions before implementation. Option D. Rely solely on the assurances provided by the digital signature platform vendor regarding their compliance with all relevant insurance regulations, without conducting an independent assessment. The correct answer is B. Proceed with the implementation of the digital signature platform after a brief review by the legal department to confirm general technological feasibility, assuming that the platform's widespread use implies regulatory acceptance. Explanation: this scenario presents a professional challenge due to the inherent tension between an insurer's desire to streamline operations and the regulatory imperative to protect policyholders. The NAIC Model laws and regulations, particularly those concerning unfair trade practices and producer licensing, are designed to ensure that insurance transactions are conducted ethically and transparently. A compliance officer must navigate these requirements diligently, balancing business efficiency with legal and ethical obligations. The correct approach involves a thorough review of the proposed digital signature policy against the specific provisions of the NAIC Model Unfair Trade Practices Act and the NAIC Model Producer Licensing Act. This includes verifying that the digital signature process meets the standards for validity and enforceability as defined by these models, ensuring that policyholders are not misled or disadvantaged, and confirming that producers are properly licensed and authorized to bind coverage under the new system. Adherence to these models is crucial for maintaining regulatory compliance, preventing potential litigation, and upholding the insurer's reputation. An incorrect approach would be to implement the digital signature policy without a comprehensive review, assuming that any widely adopted technology is inherently compliant. This fails to acknowledge the specific requirements outlined in NAIC Model laws regarding consumer protection and producer conduct. Another incorrect approach is to prioritize speed of implementation over regulatory scrutiny, potentially leading to the adoption of a system that, while technologically advanced, does not meet the legal standards for policy issuance or producer authorization, thereby exposing the insurer to regulatory penalties and reputational damage. A third incorrect approach is to rely solely on the vendor's assurances of compliance without independent verification. This abdicates the insurer's responsibility to ensure its practices align with NAIC Model laws, which are designed to protect the public interest. Professionals should employ a risk-based approach to compliance. This involves identifying potential areas of regulatory exposure, conducting thorough due diligence on new processes and technologies, and seeking expert legal and compliance advice when necessary. A structured review process, documented thoroughly, is essential for demonstrating a commitment to compliance and for defending decisions if challenged by regulators. Question 6. The efficiency study reveals that a significant number of claims are being contested due to disputes over policy coverage. In one instance, a policyholder purchased a comprehensive business interruption policy. The policy contains a clause that, when read literally, appears to exclude coverage for losses arising from a specific type of cyber attack that subsequently occurred, causing substantial business disruption. However, the policy's marketing materials and the agent's explanation at the time of sale emphasized broad protection against unforeseen events impacting business operations. The underwriter is now reviewing the claim and must decide whether to deny coverage based strictly on the exclusionary clause or to consider the policyholder's reasonable understanding of the coverage. Option A. Advise the policyholder that the policy is void due to the ambiguity and refund the premiums, as this avoids any potential coverage dispute. Option B. Automatically approve the claim without further review, assuming that any ambiguity or potential for dispute necessitates coverage to avoid regulatory issues. Option C. Investigate the claim by considering the policyholder's reasonable expectations of coverage, taking into account the marketing materials and agent's representations, alongside the policy wording, to determine if the exclusion is truly applicable in spirit. Option D. Deny the claim solely based on the literal interpretation of the exclusionary clause in the policy wording, as this is the most straightforward application of the contract. The correct answer is D. Deny the claim solely based on the literal interpretation of the exclusionary clause in the policy wording, as this is the most straightforward application of the contract. Explanation. This scenario presents a professional challenge because it requires an insurance underwriter to balance the insurer's need to manage risk and adhere to policy terms with the legal principle of reasonable expectations. The underwriter must interpret policy language not just literally, but also in light of what a reasonable policyholder would expect the coverage to be, especially when the policy language is ambiguous or potentially misleading. This requires a nuanced understanding of both contractual interpretation and consumer protection principles within the relevant jurisdiction's insurance law. The correct approach involves carefully reviewing the policy wording in conjunction with the specific circumstances of the claim, and considering how a reasonable policyholder, without specialized legal knowledge, would have understood the coverage at the time of purchase. This approach aligns with the reasonable expectations doctrine, which, in many jurisdictions, allows courts to interpret insurance policies in a way that upholds the reasonable expectations of the insured, even if a strict literal reading of the policy might suggest otherwise. This doctrine is particularly relevant when policy language is complex, obscure, or when the insurer's conduct or marketing might have led the insured to believe coverage existed. Adhering to this principle ensures fair treatment of policyholders and compliance with the spirit of insurance regulation, which aims to protect consumers. An incorrect approach would be to solely rely on a literal, technical interpretation of the policy wording, ignoring any potential ambiguity or the reasonable expectations of the policyholder. This fails to acknowledge the reasonable expectations doctrine and could lead to unfair claim denials, potentially resulting in regulatory scrutiny and litigation. Another incorrect approach would be to automatically grant coverage based on a vague sense of fairness, without a thorough analysis of the policy language and the specific facts, as this could expose the insurer to unintended risks and undermine the contractual basis of the insurance agreement. A third incorrect approach would be to dismiss the policyholder's interpretation without considering whether it stems from a reasonable understanding of the policy, thereby prejudging the situation and potentially violating the principles of good faith and fair dealing. Professionals should approach such situations by first identifying any ambiguity or potential for misinterpretation in the policy language. They should then consider the context of the sale, any marketing materials, and the overall purpose of the insurance coverage. The next step is to evaluate the policyholder's interpretation against the standard of a reasonable person. If the policyholder's interpretation is reasonable and consistent with the policy's intent, even if not the most literal reading, it should be given significant weight. This systematic process ensures that decisions are not only legally compliant, but also ethically sound and customer-centric. Question 7. Investigation of a situation where an insurance broker, MS, Evans, is approached by a new client seeking professional indemnity insurance for their consulting business. MS, Evans discovers that one of the client's key business partners is a close personal friend. MS, Evans is aware that this business partner has previously recommended a specific insurer to other businesses, and this insurer offers a competitive commission rate to brokers. MS. Evans needs to decide how to proceed to ensure she acts ethically and in compliance with professional regulations. Which of the following approaches best reflects the required professional conduct? Option A. Focus solely on the commission rates offered by different insurers, prioritizing the insurer that provides the highest commission, as this will allow MS. Evans to invest more resources in client service. Option B. Proceed with the needs assessment and recommendation without mentioning her personal relationship with the business partner, assuming it will not influence her professional judgment or the client's best interests. Option C. Recommend the insurer previously suggested by the business partner, as this insurer is known to offer competitive commission rates and has a good relationship with the business partner, potentially leading to smoother claims handling for the client. Option D. Conduct a comprehensive assessment of the client's professional activities and potential risks. Recommend suitable insurance options from the market based on the client's needs, and transparently disclose her personal relationship with the business partner to the client, explaining how she will manage any potential conflict of interest. The correct answer is D. Conduct a comprehensive assessment of the client's professional activities and potential risks, recommend suitable insurance options from the market based on the client's needs, and transparently disclose her personal relationship with the business partner to the client, explaining how she will manage any potential conflict of interest. Explanation. This scenario is professionally challenging because it involves a potential conflict of interest and the duty to act in the best interests of the client while also adhering to professional conduct rules. The insurance broker, MS. Evans, has a personal relationship with the potential client's business partner, which could influence her professional judgment. The core challenge lies in ensuring that her advice regarding professional indemnity insurance is objective and solely based on the client's needs, not on any personal benefit or obligation to the business partner. The correct approach involves MS. Evans diligently assessing the client's specific professional activities, potential risks, and insurance needs, and then recommending suitable policies from the market, disclosing any potential conflicts of interest to the client. This aligns with the fundamental principles of professional conduct for insurance intermediaries, which mandate acting with integrity, skill, care, and diligence, and prioritizing the client's interests. Regulatory frameworks, such as those governing insurance distribution in the UK, e.g. FCA Handbook Cobb's Rules, emphasize the need for fair, clear, and not misleading communication, and require intermediaries to identify and manage conflicts of interest to prevent them from adversely affecting the client's interests. Disclosing the relationship with the business partner is a crucial step in managing this conflict transparently. An incorrect approach would be to recommend a specific insurer or policy primarily because the business partner has a connection to that insurer, without a thorough needs analysis. This fails to uphold the duty of care and skill owed to the client, potentially exposing them to inadequate cover or higher premiums. Such an action would violate regulatory requirements for suitability and best interests of the client. Another incorrect approach would be to ignore the relationship with the business partner and proceed as if no conflict exists. This demonstrates a lack of integrity and a failure to identify and manage a material conflict of interest, which is a serious ethical and regulatory breach. Finally, recommending a policy that is clearly not the most suitable for the client's specific professional risks, even if it benefits the business partner or MS. Evans indirectly, would be a direct contravention of the duty to act in the client's best interests and could lead to regulatory sanctions. Professionals should employ a decision-making framework that begins with identifying all relevant stakeholders and their interests. This is followed by a thorough assessment of the client's needs and risks. Crucially, any potential conflicts of interest must be identified, evaluated for their impact, and managed through appropriate disclosure and mitigation strategies. The professional then considers all available options objectively, selecting the one that best serves the client's interest while complying with all applicable laws and regulations. Regular review and adherence to professional codes of conduct are integral to this process. Question 8. Strategic planning requires a national insurance company to develop a new marketing campaign for a novel insurance product. The marketing strategy involves aggressive pricing and exclusive distribution agreements with certain agents. Before launching, the company's legal department raises concerns about potential violations of federal antitrust laws. However, the marketing department argues that, under the McCarran-Ferguson Act, these activities, in part of the business of insurance, are regulated by state law and thus exempt from federal antitrust scrutiny. What is the most prudent course of action for the company to ensure compliance? Option A. Proceed with the marketing campaign, assuming that all insurance-related marketing practices are automatically exempt from federal antitrust laws under the McCarran-Ferguson Act as long as they are conducted by a state-regulated insurer. Option B. Launch the marketing campaign immediately to gain a competitive advantage and address any potential antitrust concerns if and when they arise from federal authorities. Option C. Modify the marketing strategy to avoid any practices that could be construed as anti-competitive, even if they are arguably regulated by state law, to preemptively mitigate any potential federal scrutiny. Option D. Conduct a thorough legal review with specialized counsel to determine if the specific marketing practices, including pricing and distribution agreements, are indeed regulated by applicable state insurance laws and therefore fall within the scope of McCarran-Ferguson protection. The correct answer is A. Proceed with the marketing campaign, assuming that all insurance-related marketing practices are automatically exempt from federal antitrust laws under the McCarran-Ferguson Act as long as they are conducted by a state-regulated insurer. Explanation: this scenario presents a professional challenge because it requires balancing the pursuit of business objectives with adherence to regulatory mandates, specifically the McCarran-Ferguson Act. The Act reserves the regulation of the business of insurance to the states, creating a complex legal landscape where federal antitrust laws may not apply to certain insurance practices if they are regulated by state law. Navigating this requires a deep understanding of the interplay between federal and state authority. The correct approach involves a thorough legal and regulatory review to determine if the proposed marketing strategy falls within the scope of state regulation and is therefore shielded from federal antitrust scrutiny under McCarran-Ferguson. This approach prioritizes compliance and risk mitigation by seeking expert legal counsel to interpret the specific state insurance laws applicable to the marketing activities. It acknowledges that the business of insurance is a fact-specific determination and requires careful analysis of whether the activities in question are integral to the insurer's relationship with its policyholders and the assumption of risk. An incorrect approach would be to assume that all insurance marketing activities are automatically exempt from federal antitrust laws simply because they are conducted by an insurance company. This overlooks the crucial requirement that the practice must be regulated by state law. Another incorrect approach is to proceed with the marketing strategy without seeking legal advice, relying solely on internal assumptions about regulatory compliance. This demonstrates a disregard for due diligence and exposes the company to significant legal and financial risks, including potential antitrust violations and penalties. A further incorrect approach would be to prioritize immediate market penetration over regulatory certainty, believing that the potential benefits outweigh the risks of future legal challenges. This is ethically unsound and professionally irresponsible, as it prioritizes short-term gains at the expense of long-term legal standing and reputational integrity. Professionals should employ a decision-making framework that begins with identifying the core regulatory issue, McCarran-Ferguson Act implications. This should be followed by a comprehensive assessment of the proposed action against relevant federal and state laws, including consulting with legal counsel specializing in insurance regulation and antitrust law. The decision should be based on a clear understanding of the regulatory landscape and a commitment to compliance, rather than on assumptions or expediency. Question 9. Operational review demonstrates that a prospective client sent an email stating, "I am very interested in your comprehensive home insurance policy and would like to discuss the coverage options further." The insurer's representative responded with a brochure detailing policy features and a preliminary quote. The client then replied, "This looks promising. I will review it and get back to you next week." Which of the following best describes the status of the insurance contract at this point, according to the principles of insurance contract formation? Option A. No binding insurance contract has been formed, as there has been no clear offer and unequivocal acceptance of all essential terms, nor confirmation of consideration and insurable interest. Option B. A binding insurance contract has been formed because the client indicated the information was promising and intended to review it. Option C. A binding insurance contract has been formed because the client expressed strong interest and received a quote. Option D. A binding insurance contract has been formed because the insurer provided a brochure and a preliminary quote, indicating acceptance of the client's interest. The correct answer is C. A binding insurance contract has been formed because the client expressed strong interest and received a quote. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of the foundational elements of an insurance contract and how they interact. The core difficulty lies in distinguishing between a preliminary expression of interest and a legally binding agreement, particularly when dealing with potentially ambiguous communications. Careful judgment is required to avoid misinterpreting intent and to ensure compliance with regulatory requirements for contract formation. The correct approach involves meticulously examining the communication to ascertain if all essential elements of an insurance contract offer, acceptance, consideration, and insurable interest are present and clearly established. This aligns with the regulatory framework's emphasis on clear and unambiguous contract formation, ensuring that parties understand their rights and obligations. Specifically, The regulatory framework for insurance contracts mandates that a binding agreement arises only when there is a clear offer, unequivocal acceptance of that offer, and valid consideration exchanged, all underpinned by an insurable interest. This approach upholds the principle of certainty in contractual relationships and protects consumers from unintended commitments. An incorrect approach that focuses solely on the initial expression of interest without verifying the presence of all contractual elements fails to acknowledge the legal requirements for contract formation. This can lead to a misunderstanding of whether a binding contract exists, potentially exposing the insurer to claims that were never formally agreed upon or leaving a policyholder without coverage they believed they had secured. This approach violates the regulatory principle that a contract is not formed until all essential elements are met. Another incorrect approach that assumes a contract is formed based on a general discussion of terms, without a formal offer and acceptance, overlooks the requirement for mutual assent. This can result in disputes over coverage and premiums, undermining consumer confidence and regulatory objectives of fair dealing. The regulatory framework requires a clear meeting of the minds on all material terms for a contract to be valid. Finally, an incorrect approach that prioritizes expediency over thoroughness in verifying the existence of an insurable interest at the time of contract inception is also professionally unacceptable. The absence of an insurable interest renders an insurance contract void ab initio, meaning it was never legally valid. This failure to adhere to a fundamental requirement of insurance contracts can lead to significant legal and financial repercussions for both the insurer and the insured, and directly contravenes regulatory mandates. Professionals should adopt a systematic decision-making process that begins with identifying the communication in question. They must then critically assess whether this communication constitutes a clear offer, followed by an unequivocal acceptance, supported by valid consideration, and the presence of an insurable interest. This structured approach ensures that all legal and regulatory prerequisites for contract formation are met before any party is considered bound. Question 10. The review process indicates that an insurance intermediary is advising a client on health insurance options. The client is a Nigerian citizen employed by a private company. The intermediary is primarily promoting a comprehensive private health insurance plan. What is the most appropriate course of action for the intermediary, considering the regulatory framework for insurance in Nigeria? Option A. Advise the client that the NHIS is primarily for low-income earners and government employees, and therefore not relevant to their situation, before proceeding with the private insurance plan. Option B. Focus exclusively on selling the private health insurance plan, highlighting its superior coverage and benefits compared to any government-provided options, without mentioning the NHIS. Option C. Recommend that the client independently research the NHIS to determine its relevance, while the intermediary proceeds with presenting the private health insurance options. Option D. Proactively inform the client about their potential eligibility for the National Health Insurance Scheme, NHIS. Explain its benefits and limitations, and discuss how it might integrate with or affect the need for private health insurance. The correct answer is D. Proactively inform the client about their potential eligibility for the National Health Insurance Scheme, NHIS. Explain its benefits and limitations, and discuss how it might integrate with or affect the need for private health insurance. Explanation. This scenario is professionally challenging because it requires an insurance professional to navigate the complexities of government-mandated health insurance programs, specifically the National Health Insurance Scheme, NHIS, in Nigeria, while adhering to the principles of fair dealing and consumer protection. The core challenge lies in ensuring that clients are accurately informed about their eligibility and the benefits of the NHIS, preventing misrepresentation or omission of crucial details that could lead to financial detriment or unmet healthcare needs. The professional must balance the desire to offer comprehensive insurance solutions with the obligation to act in the client's best interest, particularly when government programs offer a baseline of coverage. The correct approach involves proactively identifying and advising clients on their potential eligibility for the NHIS, explaining its benefits and limitations in conjunction with any private insurance products being considered. This aligns with the regulatory framework governing insurance intermediaries, which mandates that they act with integrity and provide advice that is suitable for the client's circumstances. Specifically, the Insurance Act of Nigeria and the guidelines issued by the National Insurance Commission, NACOM, Emphasize the duty of care owed to policyholders and prospective clients. By informing clients about the NHIs, the professional is fulfilling their ethical and regulatory obligation to ensure clients are aware of all relevant healthcare coverage options, thereby promoting informed decision-making and preventing potential underinsurance or overinsurance. This approach upholds the principle of transparency and fair dealing. An incorrect approach would be to solely focus on selling private health insurance without mentioning the NHIs. This failure constitutes a breach of the duty of care and transparency. Regulators like NACOM expect insurance professionals to be knowledgeable about all available health coverage options, including government schemes, and to disclose this information to clients. Omitting this information could be construed as misrepresentation or misleading conduct, potentially leading to regulatory sanctions and reputational damage. Another incorrect approach would be to dismiss the NHIs as irrelevant or inferior without a thorough understanding of its current benefits and how it might complement or substitute private insurance for certain client needs. This demonstrates a lack of diligence and a failure to act in the client's best interest. The regulatory framework requires professionals to provide advice based on a comprehensive assessment of the client's situation and all available options, not on preconceived notions or a desire to push specific products. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the client's needs and financial situation thoroughly. 2. Identify all relevant insurance and government healthcare programs that could address these needs. 3. Research and understand the benefits, limitations, eligibility criteria, and costs of each option. 4. Clearly and accurately communicate all relevant information to the client, including the existence and implications of government programs like the NHIs. 5. Provide a recommendation that is demonstrably in the client's best interest, considering all available options. 6. Document the advice provided and the client's decision. Question 11. Cost-benefit analysis shows that while term life insurance offers lower initial premiums, a client seeking lifelong coverage and potential for cash value accumulation might find a whole life policy more suitable for their long-term financial security goals. Considering this, which type of life insurance best aligns with the client's stated objectives of permanent coverage and a savings component, without requiring complex financial management from the policyholder? Option A, term life insurance. Option B, universal life insurance. Option C, whole life insurance. Option D, variable life insurance. Correct answer is C, whole life insurance. Explanation. This scenario is professionally challenging because it requires an insurance advisor to balance the client's immediate financial needs and risk tolerance with the long-term implications of different life insurance products. The advisor must navigate the complexities of various policy types, ensuring the client understands the trade-offs between premium costs, death benefits, and potential cash value accumulation, all while adhering to regulatory disclosure requirements and acting in the client's best interest. The correct approach involves recommending a whole life insurance policy. This is justified by the client's stated desire for lifelong coverage and the potential for cash value growth, which aligns with the long-term financial security objective. Regulatory frameworks, such as those governing financial advice and insurance sales, mandate that advisors recommend products suitable for the client's circumstances and objectives. Whole life insurance, with its guaranteed death benefit and cash value component, directly addresses the client's stated needs for permanence and a savings element, thereby fulfilling the duty of care and suitability requirements. An incorrect approach would be to recommend a term life insurance policy without thoroughly exploring the client's long-term needs. This fails to meet the client's explicit requirement for lifelong coverage and ignores the potential benefit of cash value accumulation. Ethically, this prioritizes a potentially lower initial premium over the client's stated long-term financial goals, potentially leading to a coverage gap later in life. Another incorrect approach would be to recommend a universal life insurance policy solely based on its flexibility, without adequately explaining the potential risks associated with fluctuating premiums and cash value performance, especially if the client is risk-averse or has limited financial literacy. This could lead to policy lapse if premiums increase beyond the client's capacity or if investment performance is poor, failing to provide the guaranteed lifelong coverage the client seeks. Finally, recommending a policy with a very high premium that significantly strains the client's budget, even if it offers substantial cash value growth, would be an incorrect approach. This fails to consider the client's overall financial well-being and ability to maintain the policy long-term, potentially leading to financial hardship and policy lapse, which is contrary to the principle of acting in the client's best interest. The professional decision-making process for similar situations involves a thorough needs analysis, understanding the client's risk tolerance, financial capacity, and long-term objectives. This should be followed by a clear explanation of the features, benefits, costs, and risks of suitable product types, allowing the client to make an informed decision. Transparency and adherence to suitability regulations are paramount. Question 12. Assessment of a situation where a licensed insurance agent admits to a colleague that they may have inadvertently misrepresented a policy feature to a client, potentially violating state insurance regulations. The colleague, also a licensed agent, is aware of the state insurance department's oversight and enforcement powers. What is the most appropriate and ethically sound course of action for the colleague? Option A. Advise the colleague to contact the client directly to correct the misrepresentation without informing the department. Option B. Recommend that the colleague attempt to resolve the issue internally with their manager before considering any external reporting. Option C. Immediately report the potential misrepresentation to the state insurance department, providing all relevant details. Option D. Suggest the colleague downplay the significance of the misrepresentation to the client and hope it is not discovered. The correct answer is C. Immediately report the potential misrepresentation to the state insurance department, providing all relevant details. Explanation. This scenario presents a professional challenge due to the inherent conflict between a desire to assist a colleague and the strict regulatory obligations imposed on insurance professionals. The state insurance department's authority to investigate and enforce regulations is paramount, and any action that could be perceived as obstructing or influencing such an investigation is a serious ethical and regulatory breach. Careful judgment is required to navigate this situation, ensuring compliance with all applicable laws and ethical standards. The correct approach involves immediately reporting the potential regulatory violation to the state insurance department, as mandated by law and ethical codes. This demonstrates a commitment to transparency, accountability, and the integrity of the insurance market. By proactively informing the regulator, the professional upholds their duty to protect consumers and ensure fair practices within the industry. This aligns with the fundamental purpose of state insurance departments, which is to supervise and regulate the business of insurance to protect policyholders and the public interest. An incorrect approach would be to ignore the colleague's admission or to downplay its significance. This failure to report a potential violation directly contravenes the regulatory framework, which typically requires prompt notification of such matters. It also represents an ethical lapse, as it prioritizes collegiality over regulatory compliance and consumer protection. Another incorrect approach would be to advise the colleague on how to conceal or misrepresent information to the department. This constitutes aiding and abetting a potential regulatory violation and is a severe ethical and legal transgression. Such actions undermine the authority of the state insurance department and can lead to severe penalties for all involved. A further incorrect approach would be to attempt to resolve the issue internally without involving the regulator, especially if the admission suggests a potential violation of state insurance laws. While internal resolution can be appropriate for minor operational issues, it is insufficient when the integrity of regulatory compliance is in question. This approach risks compounding the initial violation and may be viewed by the regulator as an attempt to circumvent their oversight. The professional decision-making process in such situation should involve a clear understanding of one's reporting obligations under state insurance laws and the company's internal compliance policies. When faced with information suggesting a potential regulatory violation, the professional should first consult relevant statutes and internal guidelines. If a violation is suspected, the immediate and unvarnished reporting to the state insurance department is the only ethically and legally sound course of action. This ensures that the regulator can conduct a proper investigation and take appropriate measures, thereby upholding the principles of fair insurance practices and consumer protection. Question 13. Upon reviewing an insurance claim for fire damage to a commercial property, the claimant, who was the original owner, has sold the property to a third party. The sale agreement stipulated that ownership would transfer upon full payment of the purchase price, which has not yet been received by the claimant. The fire occurred before the full payment was made. The claimant is seeking to recover the loss under their former property insurance policy. Which of the following best describes the claimant's position regarding insurable interest? Option A. The claimant's insurable interest ceased upon signing the sale agreement, regardless of the payment terms, as they intended to divest themselves of all interest. Option B. The claimant has a speculative interest, hoping the third party will still pay for the damaged property, which does not constitute a valid insurable interest. Option C. The claimant retains an insurable interest because they have a direct financial stake in the property until the full purchase price is paid, as the risk of loss remains with them contractually. Option D. The claimant no longer has an insurable interest because legal title has passed to the third party, and therefore the insurance policy is void. The correct answer is C. The claimant retains an insurable interest because they have a direct financial stake in the property until the full purchase price is paid, as the risk of loss remains with them contractually. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of insurable interest beyond mere ownership, specifically in the context of property that has been transferred, but where the original owner retains a significant financial stake. The core difficulty lies in determining whether the claimant, who is no longer the legal owner, possesses a sufficient insurable interest at the time of the loss to validate the insurance claim. Careful judgment is required to distinguish between a mere hope of gain or a speculative interest and a genuine financial interest that would be adversely affected by the loss. The correct approach involves assessing whether the claimant, despite the sale, has a direct financial stake in the continued existence and good condition of the property. This would typically be the case if the sale agreement includes a condition where the seller retains rights to the property until full payment is received, or if there is a contractual obligation for the seller to bear the risk of loss until a specific event occurs. In such situations, the claimant's financial position will be directly and adversely impacted by the destruction or damage to the property, thereby establishing a valid insurable interest under the principles of insurance law, which aims to protect against genuine financial loss, not to facilitate gambling. This aligns with the fundamental principle that insurance contracts are contracts of indemnity, requiring the insured to have suffered an actual loss. An incorrect approach would be to automatically deny the claim solely because the claimant is no longer the legal title holder. This fails to recognize that insurable interest can exist in various forms, including equitable interests or contractual rights, and overlooks the specific terms of the sale agreement that might preserve the seller's financial stake. Such a denial would be a regulatory failure, as it misinterprets the scope of insurable interest and could lead to the insurer unjustly retaining premiums without providing the intended indemnity. Another incorrect approach would be to approve the claim without scrutinizing the sale agreement and the claimant's specific financial exposure. This would be an ethical failure, as it could result in the insurer paying out on a claim where no genuine insurable interest existed, potentially leading to fraudulent claims and undermining the principle of indemnity. Professionals should adopt a decision-making framework that begins with a thorough review of the insurance policy and the specific circumstances surrounding the property and the claimant's relationship to it. This involves examining all relevant documentation, such as sale agreements, loan documents, and any other contracts that define financial rights and obligations. The key question to ask is, would the claimant suffer a direct financial loss if the property were damaged or destroyed? If the answer is yes, and this loss is not merely speculative, then an insurable interest likely exists. This systematic approach ensures compliance with regulatory requirements regarding insurable interest and upholds ethical standards by ensuring that insurance contracts serve their intended purpose of indemnity. Question 14. Compliance review shows that a policyholder has submitted a claim for an event that appears to fall under a specific exclusion clause in their policy. However, the wording of the exclusion clause is somewhat ambiguous and could be interpreted in more than one way, potentially including or excluding the current claim depending on the interpretation. The policyholder was not explicitly made aware of this specific exclusion's potential impact during the sales process. What is the most appropriate course of action for the insurer? Option A. Delay any decision on the claim while the insurer conducts an extensive internal legal review of the exclusion clause's wording and historical interpretations, without informing the policyholder of the reason for the delay. Option B. Immediately deny the claim based on a strict, literal interpretation of the exclusion clause as it appears to cover the event. Option C. Inform the policyholder that the claim is being reviewed against the exclusion clause and that a decision will be made, without providing further details or context about the ambiguity. Option D. Proactively contact the policyholder to explain the potential applicability of the exclusion, the implications for their claim, and offer to review the specific circumstances of their case in detail to determine the correct interpretation and outcome. The correct answer is D. Proactively contact the policyholder to explain the potential applicability of the exclusion, the implications for their claim, and offer to review the specific circumstances of their case in detail to determine the correct interpretation and outcome. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to manage risk and potential claims with the ethical obligation to treat customers fairly and avoid misleading them. The challenge lies in interpreting and applying the principles of utmost good faith and transparency, which are fundamental to insurance contracts, in a situation where a policy exclusion might be invoked. A careful judgment is required to ensure that the policyholder is not unfairly prejudiced by an ambiguous or potentially misleading policy wording. The correct approach involves proactively informing the policyholder about the potential applicability of the exclusion and the implications for their claim, while also offering to review the specific circumstances of their case. This approach upholds the principle of utmost good faith by ensuring transparency and fair dealing. It aligns with regulatory expectations that insurers should communicate clearly and honestly with policyholders, especially when a claim might be affected by policy terms. This proactive communication allows the policyholder to understand their position and make informed decisions, thereby fostering trust and demonstrating ethical conduct. An incorrect approach that focuses solely on the literal interpretation of the exclusion, without considering the context or potential for ambiguity, fails to uphold the duty of utmost good faith. This approach risks treating the policyholder unfairly by potentially denying a claim based on a technicality, without exploring all avenues or ensuring the policyholder fully understood the exclusion at the point of sale. It could also lead to regulatory scrutiny for unfair claims handling practices. Another incorrect approach that involves immediately denying the claim based on the exclusion, without any further investigation or communication, is ethically unsound and likely to breach regulatory requirements for fair claims handling. This demonstrates a lack of diligence and a failure to consider the policyholder's perspective, potentially leading to a dispute and reputational damage for the insurer. A further incorrect approach that involves delaying a decision while seeking internal legal advice without informing the policyholder of the situation is also problematic. While legal consultation is sometimes necessary, a lack of communication during this period can be perceived as evasive and can erode the policyholder's confidence in the insurer's commitment to a fair and timely resolution. The professional decision-making process for similar situations should involve a framework that prioritizes transparency, fairness, and adherence to regulatory principles. This framework should include 1. Understanding the policy terms and conditions, including any exclusions, in their entirety and in context. 2. Assessing the specific circumstances of the claim against the policy wording, considering any potential ambiguities. 3. Communicating proactively and clearly with the policyholder about the situation, potential outcomes, and next steps. 4. Investigating the claim thoroughly and fairly, considering all relevant information. 5. Applying policy terms consistently and ethically, with a focus on fair treatment of the customer. 6. Seeking legal or expert advice when necessary, but ensuring that communication with the policyholder is maintained throughout the process. Question 15. Performance analysis shows that a health maintenance organization, HMO, is experiencing a consistent decline in its member satisfaction scores related to appointment availability for primary care physicians within its network. This trend has been observed over the last 2 quarters and is approaching a threshold that, if breached, could trigger regulatory scrutiny. What is the most appropriate initial course of action for the HMO's compliance officer? Option A. Advise senior management to lobby regulatory bodies for an extension on reporting requirements related to member satisfaction metrics, citing unforeseen operational challenges. Option B. Immediately issue a warning to all primary care physicians in the network, citing potential contractual breaches due to the decline in member satisfaction scores related to appointment availability. Option C. Focus solely on improving the HMO's marketing materials to highlight the strengths of its network, downplaying the reported issues with appointment availability. Option D. Initiate a comprehensive internal audit to identify the root causes of appointment availability issues, engage with affected primary care physicians to understand their challenges, and develop a data-driven corrective action plan to improve access while ensuring network adequacy and quality of care standards are met. The correct answer is D. Initiate a comprehensive internal audit to identify the root causes of appointment availability issues, engage with affected primary care physicians to understand their challenges, and develop a data-driven corrective action plan to improve access while ensuring network adequacy and quality of care standards are met. Explanation. This scenario presents a professional challenge because it requires an understanding of how to interpret and apply health maintenance organization (HMO) regulations in a practical, performance-driven context. The challenge lies in identifying the most appropriate regulatory response to a performance metric that deviates from expected standards, balancing the need for corrective action with the potential impact on member access and provider relationships. Careful judgment is required to ensure compliance without unduly disrupting the operational integrity of the HMO. The correct approach involves initiating a formal review process as mandated by the relevant regulatory framework. This process typically includes investigating the root cause of the performance deviation, engaging with affected providers to understand their challenges, and developing a corrective action plan that addresses the identified issues while ensuring continued compliance with network adequacy and quality of care standards. This approach is correct because it directly aligns with the regulatory obligation to monitor and manage HMO performance, ensuring that member access to care is not compromised and that the HMO operates within its license parameters. It demonstrates a proactive and compliant response to a performance issue. An incorrect approach would be to dismiss the performance metric as an anomaly without further investigation. This fails to acknowledge the regulatory requirement for ongoing performance monitoring and the potential for systemic issues affecting member access or quality of care. It could lead to a breach of regulatory obligations if the anomaly is indicative of a larger problem. Another incorrect approach would be to immediately impose punitive measures on providers without a thorough investigation or collaborative problem-solving. This disregards the regulatory emphasis on fair provider practices and the importance of understanding the underlying reasons for performance variations. Such an approach could lead to provider dissatisfaction, network instability, and potential legal challenges, while also failing to address the root cause of the performance issue. A further incorrect approach would be to focus solely on financial penalties or administrative sanctions without a clear plan for remediation. While regulators may impose penalties, the primary objective is to ensure member protection and operational compliance. A response that prioritizes punishment over correction is unlikely to achieve the desired regulatory outcomes and may be seen as overly punitive and lacking in a constructive problem-solving approach. The professional decision-making process for similar situations should involve a systematic review of performance data against regulatory benchmarks. When deviations occur, the first step is to understand the nature and extent of the deviation. This should be followed by an investigation into the underlying causes, involving relevant internal departments and potentially external stakeholders like providers. Based on the findings, a compliant and effective corrective action plan should be developed and implemented, with ongoing monitoring to ensure its success. This structured approach ensures that regulatory requirements are met, member interests are protected, and the HMO operates efficiently and ethically. Question 16. Implementation of a new fraud detection algorithm by an insurer flags a policyholder's claim for review by the Special Investigation Unit, SIU. The algorithm's output suggests a potential discrepancy based on historical data patterns, but provides no specific evidence of fraudulent activity. The SIU manager is considering how to proceed with the investigation. Which of the following approaches represents the most appropriate and compliant course of action for the SIU manager? Option A. Immediately request extensive personal financial records from the policyholder unrelated to the specific claim to identify any broader financial irregularities. Option B. Contact the policyholder's employer to inquire about their financial stability and any potential motives for filing a fraudulent claim. Option C. Base the investigation's direction on the demographic profile of the policyholder, assuming a higher likelihood of fraud due to certain characteristics. Option D. Initiate a detailed, fact-based investigation focusing solely on the claim in question, gathering all relevant documentation and conducting interviews to verify the flagged discrepancy, while adhering to privacy regulations and internal SIU protocols. The correct answer is A. Immediately request extensive personal financial records from the policyholder unrelated to the specific claim to identify any broader financial irregularities. Explanation: this scenario is professionally challenging because it requires balancing the insurer's obligation to investigate potential fraud with the need to protect policyholder privacy and avoid discriminatory practices. A special investigation unit (SIU) must operate within strict legal and ethical boundaries, ensuring that investigations are thorough, objective, and do not lead to unfair treatment of individuals. The effectiveness of an SIU hinges on its adherence to regulatory frameworks governing data handling, investigation procedures, and fair claims practices. The correct approach involves a systematic, evidence-based investigation that adheres strictly to the insurer's internal SIU guidelines and relevant regulatory requirements. This means gathering all available information, conducting interviews impartially, and documenting findings meticulously. The investigation should focus solely on the facts related to the claim and potential fraud, without making assumptions or employing tactics that could be construed as harassment or discrimination. Regulatory compliance, such as adhering to data protection laws and fair claims handling regulations, is paramount. This approach ensures that the insurer fulfills its duty to investigate while upholding its ethical and legal obligations to the policyholder. An incorrect approach would be to initiate an investigation based solely on a vague suspicion or a single piece of anecdotal information without further corroboration. This could lead to an unwarranted intrusion into a policyholder's affairs, potentially violating privacy regulations and leading to reputational damage for the insurer. Another incorrect approach is to rely on profiling or stereotyping when selecting cases for investigation. This is ethically unsound and likely violates anti-discrimination laws, as it suggests a predetermined bias rather than an objective assessment of facts. Furthermore, an incorrect approach would be to conduct the investigation in a manner that is overly aggressive or intrusive, such as making repeated unsolicited contact or demanding excessive personal information unrelated to the claim. This not only risks legal repercussions, but also erodes trust and can be seen as a failure of fair claims handling. Professionals should employ a decision-making framework that prioritizes a risk-based approach to SIU referrals. This involves establishing clear criteria for when an investigation is warranted, ensuring that all referrals are supported by objective indicators of potential fraud. During an investigation, professionals must maintain objectivity, adhere to established protocols, and continuously assess whether the investigation remains within legal and ethical bounds. Regular training on fraud detection, investigation techniques, and relevant regulations is crucial to ensure that SIU operations are both effective and compliant. Question 17. Which approach would be most compliant with regulatory requirements when a primary insurer seeks facultative reinsurance for a unique, high-value property risk that falls outside its existing treaty reinsurance program? Option A. Engage legal and compliance teams to conduct a comprehensive review of the facultative reinsurance contract, verifying its alignment with the original policy's terms and conditions, and ensuring all necessary disclosures to the regulator are accurate and timely. Option B. Secure facultative reinsurance by accepting the reinsurer's standard contract terms without detailed scrutiny, assuming they are generally acceptable for such placements. Option C. Obtain facultative reinsurance by ensuring the reinsurer is financially sound and the premium is agreed upon, with minimal review of the contract's specific clauses beyond ensuring coverage for the property risk. Option D. Proceed with facultative reinsurance based on a verbal agreement with a reputable reinsurer, deferring detailed contract review and regulatory disclosure until after the policy has been bound. The correct answer is C. Obtain facultative reinsurance by ensuring the reinsurer is financially sound and the premium is agreed upon, with minimal review of the contract's specific clauses beyond ensuring coverage for the property risk. Explanation: This scenario is professionally challenging because facultative reinsurance, while offering flexibility, introduces complexities in regulatory compliance and disclosure. The primary challenge lies in ensuring that the terms and conditions of the facultative reinsurance contract accurately reflect the underlying risks and are appropriately documented and reported to regulators, especially when dealing with unique or complex risks that might not fit standard treaty arrangements. Careful judgment is required to balance the commercial needs of securing facultative cover with the stringent legal and regulatory obligations. The correct approach involves a thorough review of the facultative reinsurance contract by legal and compliance teams to ensure it aligns with the original policy's terms and conditions, and that all disclosures to the cedent's regulator are accurate and complete. This is crucial for maintaining solvency and demonstrating sound risk management practices, as required by insurance regulations. Specifically, regulations often mandate that reinsurance arrangements do not artificially inflate the cedent's financial position or obscure the true nature of the risk. Proper documentation and disclosure ensure transparency and adherence to prudential standards. An incorrect approach would be to assume that because facultative reinsurance is a bespoke arrangement, it is exempt from the same level of scrutiny as treaty reinsurance regarding regulatory reporting and disclosure. This could lead to misrepresentation of the cedent's risk exposure and financial health to regulators. Another incorrect approach would be to prioritize speed of placement over thorough due diligence on the reinsurer's financial stability and the contract's compliance with regulatory requirements. This could expose the cedent to significant counterparty risk and potential regulatory sanctions for inadequate risk management. Furthermore, failing to ensure that the facultative reinsurance contract explicitly mirrors the terms and conditions of the original policy, or contains clauses that could undermine the original policy's coverage, would be a failure to uphold the principles of sound insurance practice and regulatory compliance. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and risk management. This involves establishing clear internal procedures for the review and approval of all reinsurance contracts, including facultative placements. A robust process should include legal and compliance sign-off, verification of the reinsurer's credentials, and confirmation that the reinsurance terms are consistent with the underlying policy and regulatory expectations. When in doubt, seeking clarification from regulatory bodies or expert legal counsel is paramount. Question 18. The analysis reveals that when underwriting an agreed value policy for a classic vehicle, an insurer faces the challenge of establishing a valuation that is both acceptable to the policyholder and reflective of the asset's true market worth, thereby mitigating the risk of adverse selection and ensuring fair premium collection. Which of the following represents the most appropriate implementation strategy for determining and documenting the agreed value? Option A. Accepting the policyholder's stated valuation without further inquiry, provided it falls within a broad acceptable range. Option B. Setting the agreed value based on the maximum potential repair cost, regardless of the vehicle's actual market value. Option C. Relying solely on the vehicle's original purchase price, assuming it remains a reasonable benchmark for its current value. Option D. Conducting a thorough appraisal by a qualified independent expert, cross-referencing with recent sales data for comparable vehicles, and clearly documenting the methodology and rationale for the agreed value in the policy wording. The correct answer is A. Accepting the policyholder's stated valuation without further inquiry, provided it falls within a broad acceptable range. Explanation. The analysis reveals a common implementation challenge in insurance, particularly with agreed value policies, which is ensuring that the agreed value accurately reflects the insured's current needs and the market reality at the time of policy inception, while also adhering to regulatory requirements for fair representation and avoiding adverse selection. The professional challenge lies in balancing the insurer's need for accurate risk assessment and premium calculation with the insured's desire for certainty and adequate coverage, all within the bounds of regulatory compliance. The correct approach involves a thorough and documented assessment process at the time of policy inception to establish the agreed value. This includes obtaining sufficient information from the insured about the asset, its condition, and its intended use, and cross-referencing this with available market data or independent valuations where appropriate. The insurer must then clearly communicate to the insured how the agreed value was determined and the implications of this valuation, particularly in the event of a total loss. This proactive and transparent method ensures compliance with principles of utmost good faith and fair dealing, as it prevents the insurer from later disputing a value they themselves agreed to and documented, and it ensures the insured understands the basis of their coverage. Regulatory frameworks typically require insurers to act with integrity and to ensure that policy terms are clear and not misleading. An incorrect approach would be to simply accept the insured's stated value without independent verification or due diligence, especially if it appears significantly out of line with market norms. This failure to exercise due care could lead to an overinsured risk, potentially encouraging moral hazard and making it difficult for the insurer to justify the agreed value in the event of a claim, thereby breaching the duty of care and potentially violating regulations concerning prudent underwriting and fair premium setting. Another incorrect approach is to rely solely on historical valuations without considering current market conditions or the asset's present state. Insurance contracts are based on current risk, and an outdated valuation can lead to either underinsurance or overinsurance, both of which are problematic. This can result in disputes during claims settlement and may contravene regulatory expectations for accurate risk assessment. A third incorrect approach involves imposing a unilaterally determined agreed value without adequate consultation or explanation to the insured. While insurers have the right to assess risk, a lack of transparency and collaboration in setting the agreed value can undermine the principle of utmost good faith and lead to dissatisfaction and potential regulatory complaints regarding unfair practices. Professionals should adopt a decision-making framework that prioritizes transparency, due diligence, and adherence to regulatory principles. This involves establishing clear internal guidelines for agreeing on values, ensuring adequate training for underwriters, and maintaining robust documentation of the valuation process. When faced with a valuation scenario, professionals should ask, is the proposed value supported by evidence? Has the insured been fully informed about the valuation basis and its implications? Does this valuation align with regulatory expectations for fair and prudent insurance practices? Question 19. The evaluation methodology shows that while historical claims data for similar businesses is readily available, the client operates in a rapidly evolving technological sector with a novel product line. The underwriter must determine the most appropriate method for assessing the risk associated with this client's operations for a new insurance policy. Option A. Decline to insure the risk due to the perceived unquantifiable nature of the emerging technological risks. Option B. Conduct a detailed qualitative assessment of the client's business model, risk management practices, and the specific technological risks, supplemented by expert opinion and scenario analysis, while acknowledging the limitations of historical data. Option C. Primarily rely on historical claims data from analogous industries, adjusting for a general inflation factor. Option D. Apply a broad industry-wide risk loading to account for the inherent uncertainty in new technologies, without specific client-level analysis. The correct answer is C. Primarily rely on historical claims data from analogous industries, adjusting for a general inflation factor. Explanation. This scenario presents a professional challenge because it requires an insurance underwriter to balance the need for accurate risk assessment with the inherent uncertainties of future events. The underwriter must not only identify potential risks, but also quantify their likelihood and potential impact, a task complicated by the dynamic nature of the insurance market and the specific client's evolving business operations. Careful judgment is required to avoid both underpricing the risk, leading to potential financial losses for the insurer, and overpricing it, making the product uncompetitive and potentially losing the client. The correct approach involves a comprehensive and forward-looking assessment of all relevant risk factors, including those that are difficult to quantify. This means going beyond historical data to consider emerging trends, the client's specific risk management strategies, and the potential for unforeseen events. Regulatory frameworks, such as those governing solvency and fair treatment of customers, mandate that insurers operate on a sound financial basis and offer products that reflect the true risk. Ethical considerations also demand transparency and a commitment to providing appropriate coverage at a fair price. This approach ensures that the insurer can meet its obligations to policyholders while remaining financially stable. An incorrect approach would be to solely rely on historical claims data without considering future projections or the client's proactive risk mitigation efforts. This fails to acknowledge the dynamic nature of risk and could lead to an inaccurate premium calculation. Such a failure could contravene regulatory requirements for prudent underwriting and risk management, potentially exposing the insurer to solvency issues if actual future losses exceed projections. Another incorrect approach would be to adopt a highly conservative stance, significantly inflating premiums due to a fear of unknown future events, without a justifiable basis for the increased loading. This could be seen as a failure to treat customers fairly, as it may result in an excessively high premium that does not accurately reflect the assessed risk, potentially violating consumer protection regulations. Professionals should employ a structured decision-making process that begins with a thorough understanding of the client's business and the environment in which it operates. This involves gathering all available information, identifying potential risks and their interdependencies, and then evaluating the likelihood and impact of these risks. The process should incorporate both quantitative and qualitative analysis, acknowledging that some risks cannot be precisely measured. Regular review and adaptation of underwriting assumptions are crucial, especially in rapidly changing industries. Professionals should also consult internal guidelines and regulatory requirements to ensure compliance and ethical conduct throughout the underwriting process. Question 20. Cost-benefit analysis shows that implementing a new, more restrictive prior authorization protocol for all elective surgical procedures could significantly reduce the insurer's expenditure on outpatient services. This protocol would require a more stringent review process, potentially delaying or denying procedures deemed non-essential by the insurer's internal cost management team, even if recommended by the treating physician. Which of the following approaches best aligns with the regulatory framework for insurance law and regulation in this jurisdiction when considering the implementation of this new protocol? Option A. Inform healthcare providers that all elective procedures will now require a higher level of justification and that denials will be based on the insurer's interpretation of cost-effectiveness without establishing a formal appeals process. Option B. Conduct a thorough review of the proposed protocol to ensure it complies with all applicable regulations regarding medical necessity, patient access to care, and fair claims handling, and establish a clear, accessible appeals process for denied procedures. Option C. Implement the new protocol immediately to realize the projected cost savings, as the insurer has the right to manage its financial exposure. Option D. Delegate the final decision-making authority for all prior authorization requests to the insurer's finance department to ensure maximum cost efficiency. The correct answer is C. Implement the new protocol immediately to realize the projected cost savings, as the insurer has the right to manage its financial exposure. Explanation. This scenario is professionally challenging because it requires balancing the financial interests of the insurer with the ethical obligation to provide appropriate patient care and comply with regulatory mandates. The insurer's desire to control costs through managed care techniques must be weighed against the potential for these techniques to compromise the quality and accessibility of healthcare services, which are protected by insurance law and regulation. Careful judgment is required to ensure that cost-saving measures do not lead to discriminatory practices or violate patient rights. The correct approach involves prioritizing patient well-being and regulatory compliance above immediate cost savings. This means ensuring that utilization review processes are fair, transparent, and based on established medical necessity criteria, rather than solely on financial considerations. It requires a commitment to providing access to necessary care, even if it incurs higher short-term costs, as mandated by regulations designed to protect policyholders. This approach aligns with the overarching principles of insurance law and regulation, which aim to ensure solvency, fair treatment of policyholders, and the provision of promised benefits. An incorrect approach that focuses solely on achieving the lowest possible cost per member per month, without adequate consideration for medical necessity or patient outcomes, would be professionally unacceptable. This could lead to denials of necessary treatments, delays in care, and ultimately, a breach of the insurer's contractual obligations and regulatory duties. Such an approach risks violating provisions related to fair claims handling, network adequacy, and the prohibition of unfair or deceptive practices. Another incorrect approach that involves implementing overly restrictive pre-authorization requirements or arbitrary denial of services based on cost containment targets without a robust appeals process or adherence to evidence-based medicine, would also be a regulatory and ethical failure. This undermines the patient's right to access care and the insurer's responsibility to cover medically necessary services. It could be construed as an unfair claims settlement practice or a violation of network adequacy standards. The professional decision-making process for similar situations should involve a thorough understanding of the relevant insurance laws and regulations governing managed care. This includes familiarizing oneself with guidelines on utilization review, medical necessity, network management, and patient rights. A systematic approach would involve 1. Identifying the core issue, cost containment vs. patient care/regulatory compliance. 2. Evaluating potential solutions against regulatory requirements and ethical principles. 3. Consulting with legal and compliance departments when in doubt. And 4. Documenting all decisions and the rationale behind them to ensure transparency and accountability. The ultimate goal is to implement cost-effective strategies that do not compromise the quality of care or violate legal and ethical obligations.